Here with his take on the markets, we'll talk credit, we'll talk rates, and a lot more, is Panossian. He is the incoming co-CEO at Oaktree, current head of performing credit. Thank you for being here. I think it's the first time we've talked to you since they've announced that you're going to be CEO. We usually talk to Howard Marks. So private credit, you just stepped off of the stage where there was a whole panel here at Delivering Alpha about private credit, which I think shows how big and exciting this market is right now. How big is it for Oaktree? Because you guys have been in it for a while.
We've been in private credit for a while in both performing and opportunistic. We have about $70 billion in capital dedicated to private assets on the credit side between those two categories. We've had dedicated funds under management for over 20 years in private credit on the performing side, and on the opportunistic side, from our founding, we were very actively involved in privately negotiated transactions. And
it's growing.
Absolutely.
You're raising a new fund. What is driving the demand for lending? Does it have to do with what's happening in the banking system?
Yes, we're raising a performing private credit fund really focused on large loans to companies that are owned by private equity sponsors doing new deals. The reason we're approaching that area of the market is because the banks have stepped away, and we're able to get 11 to 13% yields on first lien, top of the capital structure, privately negotiated loans for very high quality companies that could weather a recession quite well.
Everybody's in it, though, now. I mean, even family offices on top of the, HPSs, and Ares, I know, was on your panel as well, and KKR and Blackstone. What's the risk here around this? It's not a free lunch.
Right. The risk is that there is capital flowing in, both from institutional and retail. And I would say, especially in retail, that capital needs to be deployed quite quickly. And if investors, investment managers don't take a step back and say, well, what is the best risk-adjusted return? Should I be disciplined at this moment? Should I chase this deal? It is possible to make some mistakes, just given some of the flows that have occurred. And also for those investment managers that have historic portfolios that were put in place before the pandemic and even in 2021, there is risk in some of those portfolios as well, because they were put in place at a time when base rates were near zero. And some of those capital structures were never contemplated what we've gone through since the pandemic and with inflation. So I think there is some risk of loss in older vintages.
What about regulatory as well? I mean, you could argue that money moving outside of the regulated banking system into a shadow banking system is more risky.
It is. Well, I think the regulators will have a tougher time going after the private credit managers. It is more diffuse. It isn't really structural risk. However, there is a part of the private credit, or the growing part of the private credit investor base in retail, which involves 40 Act funds and retail investors. And so the liquidity provisions that are promised to those investors may become problematic if there is an outflow, or if there are significant outflows out of the asset class, where regulators may take notice if that promised liquidity is not met.
You mentioned the double-digit rates. I mean, we are in this world of rising rates. Do you guys at Oaktree expect them to take another step up every day?
Yeah,
yields go up.
I don't think that we have a crystal ball on when rates go up or down, but I do think that given what we're seeing in the underlying economy and the markets, we should expect higher for longer. Also, as inflation is kind of trending towards the right direction of being under control, that just probably means that there are fewer rate hikes, but not really rate reductions. And therefore, if rates do stay high for a long time, we should expect to see stress. With or without a recession, we should expect to see stress in borrowers.
I haven't seen as much.